Hi, it's Jon and Michelle Braddock with the June BeneFocus video series. Today, imputed income and how it affects group term and voluntary life insurance plans. Most of us know that providing employees with group term life is fairly inexpensive when compared to the many other benefits that you provide as an employer. And this can be an invaluable benefit to the spouse or surviving children of a deceased employee. However, for a fairly inexpensive and straightforward benefit, there may be some complicated reporting that may be required of you. That's right. We're going to be talking about Section 79 of the Internal Revenue Code, which discusses the rules pertaining to imputed income and where and how they need to be applied.
As most of us know, employers may provide up to $50,000 of group life insurance to employees without tax consequences to those individual employees. Amounts exceeding $50,000 are subject to the imputed income tax. Employers must compute the cost of the value of insurance exceeding $50,000 using the IRS Table I, or sometimes referred to as Table 1, rates. Rates are based on age and applied on a per $1,000 of coverage basis. The age band that is used is calculated by using your employee's age as of December 31st of that particular year.
So here's an example. If a 28-year-old employee received $50,000 of employer-paid coverage per year, that employee does not have any imputed income.
However, if that same employee is provided with $100,000 of group term life insurance, to which he or she does not contribute, you take the total insurance amount of $100,000, subtract the $50,000 exempt amount, leaving the remaining $50,000 subject to the imputed income tax. If you recall, the rate is applied on a per $1,000 of coverage basis, so we divide that by 1,000, leaving $50 of the imputed income value. The rate for a 28-year-old employee is 6 cents, so we multiply that by 6 cents, leaving $3 of imputed or taxable income per month.
One thing to note is that this is the monthly calculation. Many organizations simply report this on the employee's W-2 at the end of the year. However, the correct method for applying the imputed income tax is on a monthly or a per paycheck basis, as insurance amounts may change during the course of the year, or this reporting may be missed altogether if an employee terminates mid-year. So how does imputed income pertain to group voluntary or optional life programs? These plans are considered toward the $50,000 limit if the plan is carried directly or indirectly by the employer.
So what constitutes a voluntary or employee-paid plan being carried by the employer? Well, there's two criteria. A plan is considered carried by the employer if the employer pays any cost of the employee's premium or dependent premium, or the premium amounts for at least one employee or dependent subsidize those paid by at least one other employee or dependent. The IRS Table I or Table 1 rates are used to determine if the premiums are subsidized.
So in other words, if your voluntary rate table straddles the rates in the Table 1 chart, then your voluntary life plan is considered carried by the employer and therefore subject to the $50,000 limit and imputed income tax. If all of your rates are above the Table 1 or all are below the Table 1, then your plan is in compliance and there would be no imputed income to calculate.
For more information on this topic, consult your tax advisor or call myself or John at ISG Advisors.